Oh my gosh! I can't believe it! It's finally out! That's right, ladies and gentlemen. The video from Gusto Payroll is now available to be viewed on our YouTube channel. Recently, last week, about 2 weeks ago, we did a YouTube live answering tax reform questions for small business owners all across the United States. That's right, baby. Me and Kenji, we broke it down. 2 CPAs walked into one room. One tax reform came right out.
Hey, look at this! Oh my God! What the hell?
That's right, it was a death challenge. Hey, listen, I want to thank Gusto Payroll for hosting the conversation. We actually had a YouTube live session for about an hour. It was a great time. We actually truncated the best of the 60 minutes down into a 31-minute clip for you guys and you guys alone. That's right. If you haven't subscribed to our channel, be sure to subscribe now, because starting in 2018, we're actually going to pivot over and start doing daily business videos. It's going to be amazing. It's going to start pretty soon, but if you subscribe now, you'll be the first in line to get all the best tips available that we can provide to you, Mr. and Mrs. Business Owner and Mr. and Mrs. American. If you haven't heard of Gusto Payroll, I want you to click in the description below. It's a perfect app for your business. Everyone should be using Gusto. In fact, if you click on the link below, Gusto will give you 1 free month. You know what I think? I think Gusto should have a Gusto Connect and hire Carlos Matos of BitConnect to intro the Gusto Connect. In fact, I think I know exactly how this would go down. AdvisorFi DJ, cue in the beat.
And let me tell you that we are really changing the world as we know it. The world is not anymore the way it used to be. No.
Today are going to be tackling the new tax reform and how it affects small businesses. To help us out, we have 2 CPAs right here. Me? And also business owners. Will, he is the founder of advisorfi.com, which is an online accounting firm for business owners. They provide accounting and financial consulting services. He's also a YouTube star. And Kenji is the CEO and founder of Acuity, which builds and maintains financial functions for entrepreneurs and small businesses. I'm Crystal. I'm on the Gusto team here. And if you're not familiar with Gusto, we serve over 40,000 businesses with payroll, benefits, and HR. We're always looking for ways to answer your top questions and pull in experts who can help guide you through all of the different important financial and business decisions that you need to make. So I want to jump right in. Will and Kenji, what are your overall thoughts on how the tax reform is going to affect businesses?
If you're a small business owner, that's who we're guessing most of you are online here with us. Again, except for our moms, we said earlier, who are watching.
Mom.
It really should mean, for the most part, that you're going to see more cash in your pocket at the end of the year. It's a good thing, right? That's the intent, was to help stimulate more capital growth within your business. Could be for jobs, right? More investing in your own infrastructure, your own growth. So yeah, it's pretty exciting. I think it's something that overall, from a high level, you should expect to have more cash. You know, if you had the same performance you had under the old tax code, you should have more savings on the tax side in the future.
So essentially, you're saying this might be a good time for small businesses to reinvest in the business.
Yeah.
If you have money on the sidelines, there's always this conversation of, as a business owner, waiting for opportunity, right? Waiting for a good opportunity. Well, if you're an entrepreneur and you're on the sidelines thinking about starting a business, or you already have one and we're kind of putting off reinvesting some money, now's the opportunity in 2018 going forward to really think about what you want to do from a business owner perspective, because this will put more money back in your pocket, which is a great thing. for you to do, obviously, as you please with, but a lot of companies will be reinvesting into employees.
Yeah. I mean, you started a business, right, to already invest in yourself. You had a belief that you could go out and create something. It's a good time now when there's going to be this tax reform that's going to give you more opportunity to invest in yourself. Now, you could, go take your extra savings and go buy a boat or something like that.
Or this nice hat.
Oh, this nice, great hat. It really is meant for job growth. And even though, I think it's called the Tax Cut and Jobs Act, there's nothing specific, I guess, that we've seen in there that's really like a direct stimulus toward hiring new jobs or credits around job creation.
I finished reading page 186, which was the last page last night. So,
but the tax cut part of it is real. I mean, it's definitely will be cutting down taxes, especially if you're a small business owner.
So let's dive into what some of those specifics are. What you were saying earlier, Kenji, is that 95% of small businesses are pass-through entities. So this is going to affect the vast majority of small businesses. So to start off with, what exactly is a pass-through entity?
What a pass-through is, it's trying to communicate an idea that you have a business that makes money and has expenses. And then at the end of the day, that business either makes a profit or has a loss. And that profit or loss passes through that business that you have down to you, the individual that you own. So, my company is called advisorfi.com. It's an LLC, taxed as a S corporation. Well, my company makes money, it has expenses, and whatever the result is, it passes down to me, the owner, and I claim it as income, and I pay taxes on it.
If you're a business owner and you're watching us now or later, it's most certainly that you're a pass-through entity. I mean, again, 95% of filings are for pass-throughs. The other 5% are for C-corps and a little more complex structure and organization. There's tax benefits that C-corps are getting as well too, but we're going to mostly talk about what's happening for the real small business owners, which you all are predominantly going to be pass-through entities.
So what is happening for pass-through entities?
Well, I mean, the big thing is the 20% deduction that you get from the performance of the business. Now, we were talking about this earlier. It's a new idea. So, kudos to those who passed it of kind of rethinking the way people make money. So, for example, if you have a business that, revenues minus expenses, you have a net performance, a net profit of $100,000, then what the code says now is that you're going to take 20% of that $100,000 income and you're going to remove it away from the 100, so you have 80 left, and on that 80 you claim and pay taxes accordingly.
It's pretty simple, straightforward, just a 20% deduction.
Does that apply to every pass-through across the board? And if not, what are some of the important limitations?
Pass-throughs, they have it in the tax reform, LLCs, sole proprietorships, S corporations, partnerships, and some real estate activities. So, which is pretty much almost every pass-through.
There are limits to it, right? So you can't, not everyone can get the full 20% deduction. Some of that can get phased out, and the triggers to kind of watch for that are kind of around compensation. If you're the business owner are making, like 100, individually is 157?
Yeah, I think the way the verbiage is, like, if your taxable income is 157 and some change as a single individual, then it starts to slowly phase away, and then once you hit, I think, 210, then it's completely gone, the benefit.
Yeah.
And then, so 300 married.
So double that for married.
Right, and then double that for married, and 400 if you're married. So
that'll end up kind of phasing some of that out, and then there are specific services, professions that were called out too,
right,
that are going to be limited as well, and that's mostly around, think about like doctors, lawyers, attorneys,
right.
So healthcare, finance,
specific
athletes they mentioned.
Yeah, athletes,
kind of
actuarial services, which I'm sure everyone is, right?
But even it's in general, it's a consulting, like professional consulting firms, so it's pretty broad. And so that's going to be interesting to see how people identify as an industry, because there'll be some of the same limitations there too. So I've talked about, if let's say you're an attorney and you've got a pretty good small practice, but you're making a pretty high income. Let's say you're making more than $400,000 or $500,000 in taxable income back yourself, you're going to be phased out. So you'll look kind of like the same situation you had last year for the most part.
Yeah,
So,
yeah, exactly. Like, a lot of people are really concerned about this phase out. Like, oh, am I going to get phased out? Well, if you get phased out, it just regresses back to what we've all been experiencing for the past 30 years.
it's not going to be worse.
It's not going to be a worse situation. In fact, even the brackets have changed.
Yeah.
So the percentage-wise, you're going to pay
On the
less
individual
tax,
side,
right?
yeah. Yeah.
So even if you do get phased out, there's still huge benefits that are happening there, because even at the 7 brackets, the ones that got affected the most were the higher brackets.
Yeah.
So people at the lower brackets may get the deduction, and if you end up phasing out entirely, people at the higher brackets, you still get a break from the percentages.
There's a lot of people who are putting out tax calculators for what it looks like from the older versus the new.
Wall Street Journal did one.
They have one. There's a bunch of them out there, and you can just go pop in your situation pretty quickly and see what the actual impact should be for you. So
Everyone is talking about the new CCorp tax break. So that rate is going down from 35% to 21%.
Right.
Some questions that we've been getting on the Gusto side from small businesses is, should we, as a small business owner, switch to a CCorp to try to capitalize on some of those benefits?
in general, what I would tell them and have told some is that the advantages are still very, very high if you're a pass-through entity today. And so converting over to the C Corp, while it sounds attractive, and it is, the 35 to 21% cut, there's still double taxation technically in a C Corp, so you're getting taxed at the company level and at the individual level. So without getting into all the specifics, you're probably going to be just fine staying at the entity that you're at today. Moving entities around sometimes to chase these kind of tax benefits can be a little dicey. Right. I mean, your entity is set up for more than just tax purposes. There's a lot of other legal purposes too. So, and once you make a change, it's a one-way street. It is very difficult to go back on that change. So we're kind of telling people to stay put.
Right.
You don't have to make that decision today. You could have a discussion with your attorney, with your CPA throughout the year, and you could, if you want to make that change, you could do it much later in the year. It's not something you have to do right now.
Yeah.
So don't rush into it, as we're saying.
Yeah, I mean, I would say like 99% of our clients at advisorfi are all pass-throughs. We have very few C corporations. And we have gotten the question where they ask us, well, should I turn my SCorp into a C Corp under this new reform? And I think if we take a step back, really, I think the spirit of the reform was to give a break to all business owners, whether they're a pass-through or a C Corp. Are there benefits in either direction? There are pros and cons to both C Corp and S Corp, but I would be very, very slow to just make a big rehaul change like that. Just a small example, if you have a C Corp and you have losses, when you go to an S, you lose the benefit of that loss. So, I mean, there's some ramifications from moving from one direction to another, and accountants call the C Corp status double tax corp. So, if you don't like taxes, if I told you, would you like to pay double tax, I'm sure you're going to say no.
I think we got our first question.
Okay.
Yes. And that question is, are there any changes to the meals and entertainment deductions? I heard that the entertainment deductions are all gone. So what do we...
What you heard was correct. Yeah, this is, so we talked about all the positive aspects, right, for being a small business and more cash in your pocket. There are some things that are going away, and this was one of them. One of the watchers picked out, which is good. Yeah, meals and entertainment is changing. Yep. Entertainment is going away as a deduction entirely. It historically was 50% deduction, and usually, a good example of an entertainment expense would be maybe your small business rented out a facility to have a company party or something like that. That facility rental would be considered entertainment expense, and you could deduct 50% of that. In the future, that is non-deductible. So that's the entertainment side. I don't know if you want to talk about the meal side, Will?
Yeah, I mean, so the meal side, if you don't already know, you actually have two ways to deduct meals. One level at 50%, the second level at 100%. So what's the distinction between the two? Well, for example, I have advisorfi.com. We actually have a headquarters down in South Florida. I buy food for my office so that my team can eat. We buy drinks. We keep it stocked with, kind of groceries. That kind of stuff is 100% deductible under the old code.
I was about to say is or was.
Was. Was deductible under the old code, but not anymore. Now it's all 50% flat across the board. Clearly, bigger companies that are spending a lot of money for feeding their staff in their headquarters, that's 100% deductible, or at least it was. Now it's not. It's 50%.
I guess this is a good point we didn't talk about earlier, is that does we recommend a lot of businesses in the past have to break out and track their meals separately by those two categories that Will mentioned, by the 50% and the 100%. That is a simplification, at least, to where often tax CPAs were having to kind of pour through and go, which are which, let's go back and look at it. There's some additional administrative costs to kind of looking through that stuff. And now it's just, you're buying food, no matter where you're buying it, who's eating it, it's 50%.
Yeah, so the entertainment's at 0%. IRS doesn't want you to have any fun, so zero fun for you. And the meals, they don't want you to enjoy it 100%, just 50% taste on the meal.
Oh, rough.
How about other important deductions or changes to deductions? So commuter benefits are a big one. Commuter benefits are no longer tax advantaged.
Yeah, we were kind of strategizing about this, and we're trying to think of like, well, how would, if we were helping cover a lot of commuter benefits at our office, what would we do? And one of the ones we cover, like for example, is parking.
So at your firm, you pay for parking for your employees?
Yeah, for sure. Yeah, we pay for parking. So we pay for, that is now considered non-deductible. So one of the thoughts we had was, well, wait a minute. We also pay, our parking deck is attached to the building that we work in. So we pay the same landlord essentially for parking and for rents of our lease of our space. I wonder if we can go to them and say, hey, listen, do you mind jacking up our rent a little bit and like giving us free parking? Because technically, if they did that all of your rent and your leasing, of the space is deductible. So we're kind of trying to think through some ideas for everybody too, of like how to obviously within reason and propriety, think of some ways that with these changes that you can still get the deductions you need and still keep some of that cash.
Yeah, obviously, and just to speak a little bit to working with a professional who is proactive, I mean, that kind of strategizing, you should be having conversations with your professional on, your tax accountant, your CPA, and there should be some strategizing. Obviously, considering this is a new reform, this is literally only a month and a half old, so really thinking through things and critically thinking through, like you said, you have to pay for parking for your employees. You give that as a benefit. Now that's been wiped away from you as a business owner. How can I grab that deduction again, go to my landlord, increase my rent, offer free parking?
Yeah.
So, I think this year and the next 5 to 10 years, there's going to be a lot of creativity that's obviously within reason, but all good things to try to figure out how to maintain those deductions, but still take advantage of the reform that just happened.
Yeah. So I think you'll see people get creative with that. Not only just parking, but maybe your business or your employer is helping you pay for public transportation costs and things like that as well too. They could change that. Many employers may switch to say, listen, we're going to up your compensation a little bit, but we're also going to make you responsible for your own commuter benefits. That could be a strategy that people employ as well.
Which makes sense. So like at advisorfi, I pay for gym memberships, and that's kind of considered entertainment. And so what I could do simply to my employees is just increase their salary, let them pay for the gym membership themselves, and I still maintain the deduction.
Yep.
I like CrossFit. It's a lot of fun. It's
more than entertainment.
It's more than entertainment, yes. It's a
lifestyle.
It's a cult. It's a gym.
Don't ask CrossFitters about CrossFit. Is that right?
Exactly. Don't ask CrossFit. Yeah.
Does any of this affect our 2017 tax returns when filing in 2018?
No, sir. Or no, ma'am. So no, it does not. This is that would have been really cool, but it's not a retroactive reform. So they didn't retroactive the reform back to 17. It's starting January 1st of 2018 going forward. The reform is actually going to happen. What really actually prompted a lot of people to spend money in 2017 was trying to grab deductions in 17 in order to lower their taxes, because obviously the brackets were higher in 17 than they will be in 18. So, people were paying like their property taxes ahead of time. Yeah. People were buying like all sorts of asset acquisitions in 20, like right in December, between when did it reform sign into law, or when did he do it? The 22nd, I believe. Yeah. So from like the 22nd to the 31st of December, people were just spending all sorts of money trying to grab deductions for the year in which the bracket system is higher.
Yeah.
And then 2018 going forward, really optimize the reform to their benefit. So
I think I saw, I guess it wouldn't affect the 2017 returns, but I did see, I think it's around some of the new bonus depreciation stuff around, that some of that actually goes back to and includes I'm not sure why. It had like in there like up to mid-September of 2017, acquisitions that were purchased then could be eligible for bonus depreciation or some of that acceleration. So that's getting a little technical, but there are certain provisions that relate to maybe things you've spent on in 2017 that look like they're going to be available for some deduction in 2018.
Right.
Not sure how they'll handle it. I guess in the 2017 return that wouldn't be in effect.
Yeah,
but
like one
there's
of
a
the
few
ones
things
that
there.
one of the ones that they pass like at the dead of night sometimes is increasing the Section 179, which is if you buy equipment, you can kind of write it off all at once.
On Section 179, can we just, what is that?
When you buy things, capital acquisitions, like if you buy, off-the-shelf software, if you buy certain kind of qualified equipment or material or office supplies for your office, many times you have to capitalize it. Like you have to bring it on your books, and then according to the tax code, you have to slowly write it off over, let's say, 3 years, 5 years. But what Section 179 does is it pigeonholes that one thing that you bought. Let's say you bought the new $3,000 MacBook Pro, and obviously that's over the $2,500 mark that the IRS says to that you can't just write it off right away. So how long does a computer last? According to the IRS, maybe 3-5 years. So you would have to slowly amortize that out, and you would slowly get a little bit of the deduction over the next 5 years. Well, Section 179 lets you just write it off entirely because it's a qualified piece of equipment. So, if you're not familiar with Section 179, you should definitely ask your professional if they haven't told you about it.
No, you said it well. I think it's just, and that's expanded. So that's around kind of bonus depreciation and accelerated depreciation has improved into the new act. So again, I think the limits are up on that. It's even a broadening of the type of capital assets that fit within that. So what that should do, and again, the thought process likely is to increase short-term spending, to get business owners spending on more. Could be real estate improvements, could be a new truck for the business, could be MacBooks, whatever it might be. That's the likely intent, is to try to get that stimulated and get more people buying bigger capital assets. And so it's a little bit of a disincentive if you buy this and you can't take the full expense immediately. So this will expand that and help small business owners when they do make those large capital purchases.
How can I deduct unreimbursed business expenses without itemizing?
It depends on what kind of pass-through you are, in which how you deduct that unreimbursed business expense. For example, if you're a sole proprietor or you're an LLC taxed as a sole proprietor, one of the biggest ones that people grab a deduction on is the mileage. You drive to a client, you drive back, let's say it's 100 miles, just easy numbers. Well, in your personal tax return, you would just say, I drove 100 miles, and you would get that deduction even though your business did not reimburse you. So it depends on the kind of pass-through. Under SCorps, that's not the case, which is a pass-through. An S corporation is a pass-through. Under an SCorp, you must literally reimburse yourself. You must, have your business take 100 miles times 54.5 cents per mile and literally give it back to yourself. So a lot of the ideas behind how can I deduct unreimbursed expenses depends on the kind of pass-through you are.
Any changes to common small business deductions that we may not know about?
Again, there's a lot in the code. So there's definitely...
where's the code? Right.
Again, right there. Unlike Will, I did not read it.
This is the official version, as you can tell.
But I do...
Isn't the IRS's handwriting
Yeah,
exactly.
so beautiful?
That's Uncle Sam's handwriting. It's pretty amazing.
You pay the government that much in taxes for that?
Such
I
good
think it'd be all higher
penmanship.
quality, wouldn't it? One that... I think another one we hadn't mentioned, but it's not as common, but there are going to be some reductions to, I think, some of the interest, deduction around interest expense. So this probably impacts some of the real estate folks maybe a bit more. I won't get into all the details there, but because I don't know all of them, but that's another, if you have historically had some deductions around interest expense, maybe the company's fairly highly leveraged, doing some real estate deals. That's one to kind of get with your CPA and take a look at, because some of those rules around the interest expense are changing as well too.
Yeah, I will say that the one that a lot of people have a hard time understanding is the standard deduction and the personal exemption on your personal tax return. So very quickly, here's how it goes. The IRS gives you a standard amount, and you can deduct that from your taxable income. And then based on how many people are on your personal tax return, then the IRS gives you another $4,000 per person. Well, in the new reform, what happened was the reform said that we're going to get rid of all the personal exemptions, so that $4,000 per person, that goes away. And what happens is there's now this new just standard amount. Now, in many cases, that deduction will be better than having a standard plus personal exemption. But where it's not better is if you have, I think if you're single, if you have more than one child, if you're married filing jointly, if you have more than 2 children. So that actually starts to negatively impact you because the more children you have under the old code, the more people in the family under the old code, you got $4,000 per person in the family, which reduced the amount of income. But where I think the code came in and tried to offset that was when they added an extra $1,000 for the child tax credit. So under the 2017 model, if you have children, you get $1,000 per child. Under the new one, you get $2,000 now per child, which I think is an accommodation to the personal exemptions going away. So at my firm, I tell my clients, they ask us, well, which is better, or which do you think is better? Getting the exemptions, which is what we had under the old code, or getting credits under the new code. Generally, the credits way outweigh the deductions because the way a credit works is it's literally dollar for dollar reduction on your taxes, or it could increase your refund dollar for dollar. Under the old code, if you got the personal exemption, it just reduces your income, which slightly reduces as a percentage your actual taxes. So, it'll be interesting to see how this thing plays out. But if you have 4 kids, so let's say you're married filing jointly with 4 children, you're going to get $8,000 in credits for the 4 children versus getting, a total of $25,000 of deductions in the exemption. So a little hard to understand, but basically, the deductions in which we used to have are going away, but I think it's going to be offsetted with that child tax credit.
So what should small business owners or folks expect from their CPA?
And I think the best way for a quick litmus test on showing if they care is, Are they proactive? Do they reach out to you? I mean, it's just that simple, honestly, sometimes. If you're like, never hear from my CPA till the end of the year, and all they're asking me is for give me your stuff. If they're not being proactive and reaching out to you, that could be a problem. I mean, there's going to be a need this year with all the changes to just communicate more with your CPA. And so while you're doing that, and maybe in some cases it will require maybe higher fees if you're doing more with them, but you should at least make sure too you're talking not just about, hey, how can you save me as much as possible this year? What does the tax code mean for me? Go ahead and share the longer range plans of the business. Get your CPA more involved. They shouldn't, you shouldn't always steer your business strategy just for taxes. I mean, I call that don't just chase let the tax tail kind of wag the full dog there, but get them involved. Sometimes that happens in situations. We see that quite a bit, unfortunately, where, small businesses only talk to their CPA. They get an email at the end of the year hey, send me all your stuff so I can stick it in boxes and file it. That's the wrong way to be doing it. You need to be having these conversations more often with them and pulling them in for those discussions around longer term growth.
Especially now with the reform. Yeah. I mean, there's so much opportunity now that you need to start having that conversation ASAP during 2018.
We have another question. Given these changes, are SCorp still the best for small businesses?
What I would say about the SCorp status is what the SCorp status really is it's a tax saving status. So, if you have an LLC or if you have an Inc., you can elect a different status inside that business that you have that helps you save money in taxes. Primarily the entitlement tax, like Social Security, Medicare, that kind of stuff. You end up not paying that into the system, which obviously puts money back in your pocket. And then in return, you have to run a W-2 wage, for yourself, and through that W-2 you pay Social Security and Medicare. So it's not like you avoid it entirely, but you avoid a big chunk of it. So I would almost rephrase your question, not so much, is it best for a small business owner or for a home business? I would say it's best for someone whose sole source of income is their business, who is looking to save some money on taxes. That is by not paying a lot in regards to Social Security and Medicare, which can be a lot, 15.3% for the self-employment tax or the employment tax if you're an SCorp. So not so much, like I said, I wouldn't kind of phrase it that way. I would just say if you're an individual whose sole source of income is your business and you're looking to save money in taxes, an SCorp is great for you. There are some pros and cons to it, but it's too technical at the moment to really dive in. But that's where you should really be having a conversation or subscribing to Augusto's channel or subscribe to our channel, and we can try to break that stuff down for you to help you make the best guess or the best selection possible.
Pretty simple thing too, when you're thinking about an SCorp, is you're going to, and this is going to sound like a Gusto plug, but just make it a Gusto plug. You guys have been awesome to have us here today. You need at an SCorp level, you've got to have a payroll system, because you need to be breaking down. You're going to have to pay yourself some W-2 wages, and you just can't. Sometimes when you're different entities or sole proprietors, you can kind of take draws and things that necessarily don't have to run through a payroll system. At an SCorp level, you're going to need to do that. So just know that, that's a very tax-effective strategy to go SCorp, like Will mentioned, but look at it situationally. Think about it as well too. Is that again, these entities aren't just for tax purposes, right? They're for lots of legal reasons as well too. So take that into consideration, and just know too that when you go SCorp, we always tell clients you gotta get on a legit, payroll system.
That's right.
Like Gusto.
Any last thoughts about the reform or anything we touched on from you guys? I think some of the big takeaways that we can think about is that this is a really good time to reinvest in the business, whether that means buying new equipment, growing, scaling, hiring more employees. There's a lot of different things you can be doing to put that capital back into the business.
Right.
And some other things are just to be aware of some of the new deductions and changes, and that you would want to work with your CPA to really figure out, are there creative, legal, compliant ways to shift things around to make sure that you are capitalizing?
Yeah. I would say, I don't know how you guys feel, but I am crazy excited about this reform because it's just a wonderful opportunity. I'm a small business owner just like you guys. So I just so happen to do accounting. It's just a wonderful opportunity. It's really refreshing to be part of like a new reform that really rehauled a lot of the heartaches of the tax world. So, it's a great time to be an entrepreneur. It's a great time to dive in. And now more than ever, there are amazing tools out there that you can use for your business, like Gusto, like Xero. There's so many things now that as a small business owner, for the past 100 years, you guys have been griping and like going to a professional like me and saying, please help my business just run better. And so, but now's the time where I feel like, the captives have been set free, not only in the business world, but also in the tax world. So it's we've let the prisoners out of the gates, kind of thing. Kenji and I are like, have the key and like, come on, join us, that kind of thing. So it's really cool to be a part of something this big.
I think I counted 5 different analogies that Will just threw out there. That's just how excited he is, but it's awesome. I agree. It's again, really as a small business owner, we're probably going to be impacted the most by this in a positive way. So take just that opportunity. Get in better discussion with your CPA. Think about how you can grow the business. You're going to have more cash available. And maybe if you do want that boat or something else too, you want to take more money off the table as well, it's an opportunity to do that. But I think it should be a good year at least to reconnect with your accounting professional and start asking some questions that maybe you haven't asked or they haven't challenged you with in the past.
Thank you so much for joining us. You guys had amazing questions, and thank you, Will and Kenji, for offering your expertise and guidance to navigate our way through this new reform. Some PSAs, we have a Facebook community called Talk Shop, which is for small business owners like you or people who handle and run everything from payroll and HR in their company. So this is a great group to join if you want to ask questions, learn from other small business owners, and just share best practices. We'll have a link in the description. And then we also have a whole host of YouTube videos on payroll, benefits, and HR called Ask Gusto, so we invite you to check them out. And also, we want to know your thoughts after this, so let us know if you liked it, you want more of these, if it sucked. We also want to hear that. Any suggestions?
Thumbs up, thumbs down.
Yeah, bring it. We're all ears. So thank you again for joining us, and that's it. Go on and be merry. Have
all right, make it a good 20.
Thank you for watching. Be sure to follow us for more business and tax reform information. Hit the button below to follow. Hit the video over there for more. If not, I am going to touch your spaghetti. Thank you, America, and see you at the next video.